Welcome to this explainer. Today, we're diving right into what I like to call the core engine of accrual accounting, adjusting entries. If you're figuring out how businesses actually track their true financial health, well, this is exactly where the magic happens. Now, imagine this. You pay for 2 whole years of business insurance upfront today. Or let's flip it around. A freelance client pays you thousands of dollars before you've even done a single hour of work. How do you record that accurately right now? The cash has definitely moved, but the actual economic reality of the business, yeah, it hasn't quite caught up yet. And that right there is the exact timing problem we fix with the adjusting process. It anchors us to what accountants call the matching principle. Basically, our ultimate goal is to make sure our financial statements reflect economic reality. We want to match expenses and revenues to the exact period they actually belong in, not just when the cash happens to change hands. So here's our game plan. We've got 4 distinct categories to cover: prepaid expenses, unearned revenue, accrued expenses, and accrued revenues. All right, let's kick things off with category number 1, prepaid expenses. This is the classic cash paid in advance situation. Think of this like paying your rent for the next 6 months, or maybe buying a massive software subscription. You've parted with your cash, but you haven't actually consumed the benefit of it yet, right? So the cash leaves your pocket on, say, December 1st, but the actual benefit of that expense, like the right to use that software, stretches way out into the future over the next 23 months. So to adjust this fairly when we close our books on December 31st, we always use a really simple 3-step process. Step 1, what is the current account balance? Step 2, what should the balance equal now that some time has passed? And step 3, we just record an adjusting entry to bridge the gap between step 1 and step 2. This shows us exactly how much of that asset we've essentially used up. Translating that logic into our debits and credits, here's what we do. We decrease the unadjusted asset account simply because we have less prepaid value left, and we increase the expense account. Why? Because we need it to match the reality of what we've actually consumed during this period. Let's look at a real-world example to make this super clear. Let's say you paid $2,400 for 24 months of insurance on December 1st. Step 1 tells us your current balance is $2,400. Step 2 says, hold on, 1 month has passed, so the remaining balance should actually be $2,300. Therefore, step 3 is just a $100 adjustment. You literally just debit insurance expense for $100 to recognize the cost for December and credit prepaid insurance for $100 to reduce your asset. Boom, done. Moving right along, let's hit category 2, unearned revenue. This is the scenario where you get paid early, cash received in advance. This happens when a client pays you before you've actually delivered the product or service. The cash arrives early, let's say on December 27th. But wait, you haven't actually done the work yet. This means legally and economically, you technically owe the client either their money back or you owe them the sweat of your brow. So it's a liability. So the crucial point here is that when December 31st rolls around and you've done a little bit of the work, we must decrease our liability account because, well, we owe them less, and we increase our revenue account to finally take credit for the specific amount of work we've actually completed. Here's how that actually plays out in the numbers. If a client pays a $3,000 fee upfront for 60 days of consulting, by December 31st, 5 days have passed, meaning you've earned 5 days of that fee. 5/60ths of $3,000 is $250. So you debit, meaning reduce, your unearned consulting revenue liability by $250, and you credit, meaning recognize, $250 in actual consulting revenue. You are perfectly matching the revenue to the period you did the work. All right, jumping to the second half of our matrix, we have category 3, accrued expenses. These are expenses that are incurred but currently unpaid. So we're leaving deferrals completely behind now and moving into accruals. These are situations where the action happens before the cash ever moves. The economic event, like your employees working super hard for you at the end of December, happens first. But as any college student waiting on a paycheck knows, the cash won't actually leave the bank account until payday in January. To build out our adjusting entry and fix this missing information before we print out those year-end statements, we need to increase our expense to reflect the resources we used, and increase a liability to clearly show the whole world that, yes, we owe this money. For example, if you pay an employee $70 a day and they work Monday through Wednesday right before year end, you absolutely owe them for those 3 days. Even though payday isn't until next year, You must record a $210 debit to salaries expense and a $210 credit to salaries payable right then and there on December 31st. And that brings us to our fourth and final category, accrued revenues. These are revenues you've earned, but they're currently unbilled and unrecorded. Honestly, this is absolutely the best kind of problem to have. It means you've successfully earned money but just haven't billed the client yet. The recognition comes first here. You've been working hard on a project for weeks in December, generating real value. But the cash receipt? That's a future event happening next month when you finally send out the invoice. Now, because we can't just pretend that work didn't happen, we need to increase an asset, specifically accounts receivable, showing we have a legal right to receive that cash. Simultaneously, we increase our revenue account to get the much-deserved credit for the work we've done this year. Let's put some hard numbers to it. Out of a 30-day, $2,700 contract, if 20 days of hard work have passed by year-end, you have legitimately earned $1,800 of that total. So you simply debit accounts receivable for $1,800 and you credit consulting revenue for $1,800 to reflect reality. Okay, let's step back, take a deep breath, and look at the big picture. Here's a quick summary of everything we just covered. Think of this matrix as your ultimate mental cheat sheet. Notice how whether cash comes first in deferrals or cash comes later in accruals, the underlying logic is always exactly the same. We adjust the accounts so the expense or the revenue is matched perfectly to the period it actually belongs in. Folks, that is the matching principle in action. So I want to leave you with this final thought. Without these crucial adjusting entries, what story would your financial statements actually be telling? Your balance sheet and income statement wouldn't just be slightly off. They would be telling a fundamentally untrue story about the health, profitability, and reality of your business. Mastering these 4 entries isn't just about passing an accounting test. It's about learning how to translate real-world actions into absolute financial truth.